Welcome to the daily update, where I'll go over the action in the market for Wednesday, September 3rd, and we'll see how things look for Thursday, September 4th. Really, if you take Google out of the mix, it was kind of a boring day. The mega caps did pretty good. Our smart money indicators are looking pretty solid, but we're not seeing a lot of strength throughout the broader market. And instead of leaning more negative like we were after Tuesday, now we're kind of leaning back more positive, but there's really no conviction now. And our short-term indicators are not really showing us that the market's either positive or negative. They're just kind of floundering around again, where after Tuesday they were starting to look more negative. Now, one thing that did happen, and I'll point this out as I go through the charts, we did fill the gap from Friday to Tuesday. There was a gap lower in Tuesday's session that we never got back above. Well, the advance that we saw on Wednesday went back and filled in that gap. So, okay. That's one thing about technical analysis is this idea, even though it's not 100%, that gaps need to be filled. Okay, well, we filled that gap, and now we'll see. Thursday and Friday, these are the days we're going to get some big employment data. Now, not big in the sense of unique that we don't get before, but this is kind of what's the market's really focused on as far as, okay, is the Fed going to come in and cut rates? Can the Fed justify cutting rates if the employment situation is strong? Now, we did have a report come out on Wednesday that showed some weakness. Are we going to see that be the theme? We've seen real discrepancy between some of these employment reports that we get. The ones that the market tends to pay attention to the most are the weekly and continuing jobless claims, and then the employment report on Friday, with the other ones kind of coming in. And it depends on what narrative you want. If you want things to be more robust for employment or showing more weakness in employment, you could use some of those other reports to justify your stance. Okay, so right at the open, we had a gap higher open. We did bounce up. There was some positive news out there in the tech sector that helped things. And we were able to open above R1 at 64.35. So we're still above that 6,400 level. We lost it in Tuesday's session and we were able to get back above it. And we did see late day buying on Tuesday, and we saw a bit of a continuation of that in Wednesday's session. But right after the open, we chopped between R1 and R2, which was 64.54. And then that set the intraday high. We almost got back there, not quite. And it was a kind of a choppy day. But then after that, it looked like, okay, we set the high. Now we're going to go down. We went all the way down to the unchanged level. So we gave up all the gains that we saw. But in addition to the R1, R2, S1, S2, the unchanged level is also a built-in support or resistance level, and it was a support level in Wednesday's session. Then we did see some late day buying, and we saw that on Tuesday. And so there is some positive action going on, this buy the dip mentality, where late day buying took prices back up to close slightly below R2. So we were up 0.51% on below average volume, even though Labor Day is now come and gone. We're not really seeing much of a pickup in volume, but that may change because the big reports are coming out in Thursday and Friday session. We'll see if volume does pick up there. Now we're back to positive on all three time frames. With the up day on Wednesday, we were able to recapture the 20 period moving averages, both the simple and exponential. So we had dropped to negative in the short term after Tuesday because we were below the 20 period moving averages. Now we're back above it. We are seeing some weakness kind of drifting through the intermediate term. But again, a good solid update could take care of that. But we're just not, we're just seeing this kind of drifting up, and then we do see some downward moves, but then the buy the dippers come in and that repairs some of the damage here. And interest rates really dropped with the 10-year yield. So that did help stocks in that way. And then just all the stuff that's going on, not really having that much of an impact on the markets overall. So a federal judge ruled that Google can retain its Chrome browser. Okay, all right. That's a little bit different than if you remember back to the late 90s, early 2000s when Microsoft had to give up something that doesn't really even exist anymore, Internet Explorer. They had to separate it out, even though it was free software. Well, that was ruled a little bit different, and Microsoft had to break up into different companies. Well, this judge ruled that, nah, Google can go ahead and hang on to that. And this will allow Google to remain the default engine on the iPhone. And there's a lot of iPhones out there. And so Google shares like that. So what ended up happening is mega specifically Google, really outperformed, and we did get back above the 20 period moving averages. We had a lot of Fed speak out there. This is the Federal Open Mouth Committee because this is their chance to shine. Where Governor Waller, who I've heard here and there, is potentially in the running to be the next chairperson. So if that's true, we kind of pay a little bit more attention to what he says. He said he supports a September rate cut. All right, that kind of helped the market, pointing to a labor softness. Now, they probably already have seen the employment report, so they kind of already know what's going on. They get these reports before we do so that they can make any kind of decisions and take a stance. They're not hit, out of left field by things. And he also acknowledged the potential for a near-term inflation uptick, but said he expects it to fall back to the 2% target. They've been saying this for a while. And of course, when the Fed comes to inflation, remember transitory, which turned out to not be all that dependable of a statement. Okay, so we'll have to see. We still have yet to get down to that 2% target. And that's, of course, is the hope, and that makes things better if inflation is more manageable. But they had made these predictions before, the Fed as a general body, and they didn't really work out that way. All right, then St. Louis Fed President Alberto Musalem, I guess is how you say that, also noted weakening labor conditions, though he cautioned that tariff-driven inflation could be more persistent than current forecasts suggest. Okay, and you've got people flying around saying that kind of a thing. We just have to wait for the data to come out and see what kind of an impact tariffs are going to have. And then Atlanta Fed President Bostic, who's not a voting member, stated he could support a September rate cut if the job market deteriorates more than anticipated. So if we get a weak number on Friday with the employment report, that's probably going to lock in this idea that there's going to be a rate cut. So we'll just have to see, because if the numbers come in really weak, the market might freak out that we're seeing deterioration that's more negative. If we just see a general weakness that supports a rate cut and the Fed comes in to cut rates just to kind of tweak the employment situation and other parts of the economy, that might be taken as more positive. And then Waller, also later in a separate thing, emphasized the central bank's independence when asked generally about governance. There's kind of that going back and forth. They're supposed to be independent. They're not supposed to be political. They're not supposed to be influenced by whether it's Democrat or Republican or what have you. We all know that goes on, but that's in theory, they're not supposed to be influenced that way since they're independent. Then Senator Thom Tillis will not consider any replacement for Cook because they had this hearing last week, but there was no decision that was made. And so it's like, okay, what happens next? And so it's like, well, are we going to pick another person to replace Cook on the Fed? We don't really know what to do until there's some kind of a decision that's made. And then, okay, this is actually incorrect. This is a statement that should not be in here. We regained the 20 period moving averages, but we're still negative with the parabolic SAR. Takes a little bit more than Wednesday's move to change that. And on a short-term basis, we only have the stochastics that are looking extreme, and that's the long short-term chart there. And then the Chaikin oscillator. Now, the smart money indicators have been showing some strength, and that's positive. We want the smart money indicators to be positive if we're more positive on the market. It's getting a little extreme, though, and I'll show you that chart as well. No change to the scenario. It's probably going to come down to what kind of employment data is going to come out because the markets are pretty much, they're figuring on at least a 25 basis point cut when the Fed meets later in September. Dollar was down, interest rates were down. We dropped quite a bit. We were at 4.28% with the 10-year yield. We dropped down to 4.21%. And sentiment is back to neutral. Even with the up day, we're seeing some internal weakness going on that's continuing to build. And so sentiment is actually dropping down. We went from positive at 62 down to neutral at 54. And we're back to looking positive again. See, this is signs of this market that's really lacking conviction. We had a Friday and Tuesday were down days. We started to turn more negative with our trend. Then we have an up day on Wednesday. We turn back more positive with the trend. Really choppy right now, but we're still weakening with the ADX. It can't figure out what to do. Are we going to go positive? Are we going to go negative? It's below its moving average, but it's still above 20. So we are still trending with the up day. The bias is positive, and I'm keeping our momentum at mixed. Even though it was an up day, we're seeing some internal weakness that I'll show you as we go through things here. So we did get the weekly MBA mortgage applications index. It was down 1.2%. Last week it was down 0.5%. Factory orders were down 1.3%, a little bit less than the 1.4% decline they had anticipated, and actually an improvement from the negative 4.8% decline we saw last time. And the JOLTS job openings came in weaker than the previous reading at 7 point, you could round it up to 2, where you could round this up to 4, 7.4 million there. So looking at some charts here, this is the weekly applications. Not this really doesn't impact the market. This just gives us an overall idea because mortgages and refinances, it's such a huge part of the US economy. Well, it's still looking negative here, but not really dropping all that much. And then we look at factory orders on a year-over-year basis, declining but still above zero. And durable goods year-over-year declining, but also still above zero. Non-durable goods actually dropping back down here to the zero line. Not an awful lot of strength in these charts right now. And then if you take out aircraft on a year-over-year basis, we're starting to flatten out just a bit under the 5% level there. And then the job openings, we're seeing this coming down a little bit, not turning negative, but it is starting to drop off, and we're not seeing as robust of employment numbers according to this report as we have been seeing before. Okay, and we get this every week, the overbought, oversold composite, still giving us a pretty high reading at 88.49. And when we get up to this level, especially if we get above 90, that means the market is overextended, looking way overbought at that point. Even with the decline from Friday and Tuesday, we did drop down a little bit, but it's still a pretty robust number overall. Then one of the best 100 days ever, more good times, question mark. Okay. Well, how does the S&P perform after greater than 25% in 100 days, going back to 1950? Pretty good. And of course, the further you look out, the better it gets. 1 month out, okay, pretty high success rate there, with a return of about 1% for the median, and the average is 0.7%. 3 months out, and then 6 months out, it looks better a year out now, up 73.8% of the time with a median return of 10.4%. That's pretty robust there. So positive tends to deliver more positive, especially if the fundamentals behind them justify that. ISM manufacturing in the S&P, we're still seeing a bit of a disconnect here where you can see these tend to go in the same direction from each other. They've kind of this has been coming down a little bit with the S&P where we've been coming up. That's actually showing a bit of an improvement, but they've been disconnected from each other over the last few years. And then ISI sees a 20% rally. Yes, okay. You can come up with all your predictions and people make their decisions based around people that are supposed to know what they're talking about, but they think that we're going to go higher with the S&P by the end of 2026. Of course, you can predict pretty much anything, and then we start going down and all these predictions change. We keep going up and we see more modifications to the predictions. And the S&P annualized 1 month volatility seasonal composite. We're coming into that time, and I've been showing this now for a month or so in the daily videos here, where the seasonality of the VIX really picks up. Well, this is annualized out, and it also shows where the VIX picks up. And it could have started back in August, but it didn't. And it's not really starting yet in September, but we're just new into the month. We'll see if that picks up as we go through the month. And fund flows, a lot of money still going into cash, seeing more money going into bonds. And there's still money going into stocks, but it's not as much as the other areas. Then ultra long bonds typically perform poorly in September. Okay. Yeah, this is just historical data here showing that September is not a good month for bonds. And then this, I go over in the weekend video. We look at and in Friday's video, we look at individual investors and how they're feeling. Well, they came up with this chart, even though it's a few days old here. They're still more net negative or bearish than they are bullish on things, which could actually work in the market's favor. When they get to a really high reading up here, that's when we start to get nervous, thinking the market is really too exuberant according to individual investors. Now, we can see that in other charts. We kind of use this in the context with those other charts and put it all together. But the fact that there's still more bears than bulls with individual investors, that means, okay, they're more pessimistic. That might be a good time to buy. Now, that's the contrarian view. Where you go with this just means that there's still a lot of negativity out there, and it might lead to more selling if we really do start to decline. And then the market implied U.S. recession probability. I look at the average overall, pretty low right now, 18% average here, and that we're going to go into a recession in the next year. And then the average, are we in a recession right now? We've got 2%. And according to all the charts I look at, we're not in a recession right now. Homeowners versus renters, we're seeing a real change here. Home ownership, that was the real backbone of the U.S. economy. You want to own your own home. That's starting to decline, and we're seeing a real pickup in renters recently. And then holiday outlook survey, consumers expect their seasonal spending, like for Christmas and so forth, to decline on average by 5% from a year ago. The first notable drop since 2020 because nobody had anything else to do except buy things online. More broadly, 84% expect to cut back over the next 6 months, citing rising prices, new tariffs, and higher costs of living. Yeah, inflation is still there. And even though we're still at a more manageable inflation rate, you still have the inflation rates from previous times that are still part of the compounding of how inflation is impacting folks. And so it's like, okay, inflation's going up, prices are going up, we're going to have to cut back in Christmas. Then here, the JOLTS job openings, this breaks it down a little bit more. It ticked down 4.3%, where it was at 4.4% before, as available positions fell by more than expected. Rates for hires, quits, and layoffs and discharges were unchanged. The number of vacancies per unemployed fell below one for the first time in a long time. So this is showing a little bit of weakness in the bigger picture. And then the U.S. versus the rest of the world. Yeah, the U.S. market has been underperforming in 2025. I go through that in the weekend videos, and we see some improvements here, which kind of goes in line with this blue line tending to go up a little bit, but it's not really outperforming as it has been in the past. And then we have another look here. Seems like we get these charts all the time. We're overvalued. So we're at 21.4 here with the US. That's measuring the S&P 500, even with the forward-looking PE ratio. When we get above 20, that's when we're considered to be expensive, and then you can relate that to the rest of the world. Okay, so here's the chart. And what I'm talking about was more positive action here. If you take out the gap on Monday, the price action within the day was not all that bad. Unfortunately, we can't do that. We can't, this isn't a buffet unless you got in right at the open but actually, yeah, Monday should be Tuesday. Okay. A little bit wrong here with the dating. Okay. I had the 3-day weekend too, but we did gap down here. And then, but what I'm picking up on is later in the day, we saw some buying coming in. And that's good. We want to see late day buying. That shows more strength. Well, then we open here in Wednesday's session. Again, disregard these dates at the bottom. And we just kind of chopped around. We got up to R2. That set the intraday high. Then we came all the way down to the unchanged level, acted as support. And then we did see some late day buying going in. So you have late day buying in Tuesday session, late day buying in Wednesday session. That's a sign of strength, and that's looking more positive there. And then not much of a change. The futures are pretty quiet, 6, 7 hours before the open as I got ready to record this. And we're still seeing that. Most of the price action is happening during the trading session, not necessarily. We did have a gap into Tuesday's session, and that's where a lot of the damage was done. But we're not seeing that as much right now. We're seeing more price action occurring while the market's open. We are seeing an improvement here. The intraday growth to value ratio, where the blue line was well below the red line, and they're both going back up overall here. So we're seeing the blue line improving in this regard. And we're seeing an improvement here with the growth to value ratio for the S&P. We're coming back up. We're getting above the moving averages again, where we had been seeing some weakness. Now, the end of day, though, we were up pretty solid and we were down with value. We were down less a little bit with the mid caps and down more with the small caps. So we're still seeing a bit of a trailing off here with small cap growth to value. It's still in a longer term uptrend, but it had been going sideways and now starting to show some weakness. We're still below the 50 period moving average of mid cap growth to value. A little bit of a tick up below the 50 period moving average of S&P growth to value. Slight improvement there, but still in the bigger picture, we're positive. Going back to the beginning of August, we're a little bit concerned about this as this has been going down since the market is becoming more defensive. Came back up, but still at the high end of the rainbow with the growth to value ratio here. And a little bit of a tick up. This is one of the better areas. We're seeing staples coming down as discretionary has been going up, and that's helping this ratio to go up as well. And so here's the short-term trend. We're back. You see, we crossed the red, went above the green after Tuesday. Now the green's back above the red. It's really choppy right now. That we can get choppy for periods of time. We've seen that a little bit more in 2025, but we're getting down here where we're actually dropping into a trendless environment in the short term. We're below the moving average and dropping below 20. We're not below 20 yet in the intermediate term, and that's what I do at the beginning when I say if we're trending or not trending. It's a weakening trend. We're below the moving average, but we're still above 20, and we've turned back to look more positive. And we're still below average with volume here. You can see this histogram showing red. That's below average volume. Okay, we ticked down just a little bit on a closing basis with the VIX. We're still below 20. We're trying to come back down to the moving averages here, both with the line chart and the bar chart. This is the seasonality that we're still waiting to see. Is that going to happen? Where we're still below 20, but quite often when we see stocks decline, whether it's August, September, even into October, the VIX will have a tendency to really pick up. And we're just not seeing that right now, at least yet. And then we look at the VIX of the VIX, where we're coming down, but still above the moving average with the bar chart and the line chart. So the volatility is picking up just a little bit there. Not enough to bring up the MACD, where we try to measure the momentum of the VIX. It's still not really showing much conviction there. And even though this is declining, we're still in the red area with the VIX. So the market is still anticipating a big move. That could be an anticipation of Thursday and Friday's employment data that's coming out. Seeing a contradiction here. We declined with this fair gauge where we went up with this other fair gauge. So they're not necessarily confirming each other. Saw a bit of a decline with the daily equity put call ratio chart, but we're still going up with the 5-day chart and we're going up with the 10-day chart. That tends to be more negative when we see this chart going up. And we are seeing an increase here. We came out of the band with volatility risk premium. We're really coming down. We settled at the lower end of the band. Now it's starting to come back up. So we want to keep an eye on this. If this continues to go up, that might signal some fear coming into the market that we're not necessarily getting from our other charts. And we actually declined here with the advanced decline line based on price and volume. Bigger picture, though, we're positive, but this didn't pick up the advance that we saw on Wednesday. And we're still below the midpoint here with the short-term advanced decline ratio, and we're continuing to decline with the intermediate-term advanced decline ratio. We're still below zero with the short-term advanced decline ratio based on price and volume. So even with the up day, this didn't turn back to positive. And we're seeing a bit of weakness here with our advanced decline oscillator. We were above zero. It actually went up after Tuesday. Now it came back down after Wednesday and is actually dropping below zero. But you can see through July and into August, we're not really seeing an awful lot of conviction. A lot of this is we go up a little bit, then down, then up a little bit, then down. We're not really seeing any extreme readings after we saw that one right at the beginning of July. And rolling over a bit with a 5-day and 10-day chart here with the highs minus the lows. A little bit of an expansion of the new highs, a few new lows here, but it's causing the moving averages to roll over slightly. But our smart money indicators are looking pretty good here. We're above the moving average with accumulation distribution. We saw enough of an upward move. You could make a case that we're not quite above the moving average here, but this is looking better. This is where we're seeing some real positive action with the Chaikin money flow going up with the histogram and the red lines going up. And we're getting above this red line here. This is why the Chaikin oscillator is on the extreme positive list. I add it to the list when it goes above the red line. We really get concerned if it goes all the way up to the green line. And again, there's nothing magical about these lines. This is just when we start to pay more attention to it. And we're still even for 2 days now. We've seen the vortex kissing each other here. It's neither positive nor negative. I would still lean positive because that's what it was for most of the time here. So it hasn't actually turned over and gone negative. So still above the moving average with the NYSE common stock when we look at the advanced decline line studies. A little bit of a decline with the S&P. Now we're dropping below the moving average with the mid caps and slightly below with the small caps. So there's some weakness coming back in there. And the percent of stocks in the S&P above their 20-period moving averages continuing to decline even with the up day. Longer term, I'm still making note of we were going up with the S&P. We were making lower highs here. That's a negative divergence. Also, you could say a bit of a negative divergence here with the 50-period moving average, but it also declined. We declined with the 100-period moving average and the 200-period moving average studies. Short term here, we're kind of right back up to this previous pivot point that had been acting as support and as resistance, depending on what day it was. But we did come in and fill this gap. I'll point this out where it's a little easier to see on some other charts. And we're below average with volume. So we're pretty much flat with the 20. We declined a little bit with the 50 and a little bit with the 200-period moving average study. Where we had been extreme negative, we bounced back up with the Stochk RSI. And we bounced back above the midpoint with the Williams percent R. We were extreme with the CCI 14. Now we're bouncing back up to the midpoint. And we're crossing back above the midpoint with the CCI 20. So no real conviction right now. And going back up in the short term, we're back above the midpoint. We're still declining with the intermediate short term, and we're declining but still extreme positive with the long short term stochastics chart. And where we were slightly below zero with the force index, now we're slightly above zero, and it's turned back green, looking positive. Still seeing some vulnerability, though, with the short-term trend based on 20 periods. We're spending a number of days down below these lines, and they're rolling over just a little bit. Not turning down, but just seeing they're not really going up at this time either. And we were able to get back above the 20-period simple and exponential moving averages. And we got back above this short-term anchored weighted moving average here. We had fallen below it and actually closed right about on it. And now we got back up here. And we're back up above the midpoint with the standard deviations chart. We're in the +1 channel. So we're still kind of declining, but leaning positive with the balance of power. No go, no go is looking more negative when it changes to the lighter shade of blue after being dark blue. And we're just a little bit above the midpoint with the highest high value chart. Longer term, the Landry light still has us in an uptrend here. This is the 86th trading day, and we're still in an uptrend here with proper order. We're still looking more negative, though, with the TTM squeeze, dark blue and declining. And we're just a little bit below zero here with the ease of movement. But this thing has been flatlined pretty much all summer. And even with the up day, the S&P McClellan oscillator continues to decline below zero. So we're declining with the summation index based on price and volume. And we ticked up, but we're still below zero with the NYSE McClellan oscillator. So very choppy, but headed down. It's really hard to see because we've been so choppy. But we are declining with the summation index based on price and volume for the NYSE. No change to the Arun, still leaning more positive. There's more buyers than sellers right now. Still with our momentum oscillators, though, we're declining with the PMO. We're turning down a little bit more based on price. We've been looking a little bit more negative here based on volume with the PMO. And we're declining below 50 with the PMOs that are rising. We're starting to drop below 50 with the buy signals. Starting to roll over slightly, but still well above 50 with the PMOs that are above zero. And we're still negative with the Swanland trading oscillator, declining based on price and volume. And then we look at our momentum oscillators. Negative here with the slope oscillator, negative with the MACD. So the slope and the MACD, they're negative, and we're seeing confirmation here. All of our short, intermediate, and long-term oscillators continue to decline. And while I'm looking at it here, this is what I'm talking about, where we had this was Friday, and then we gapped down. We closed well off the high, or excuse me, well off the low, but we came back and basically filled this gap in Wednesday's session. So are we going to go up from here? Is this fill the gap and now we're going to go down? That's what we're trying to ascertain here. But the Copic curve continues to be negative, and we did go back up, but we're not extreme with the Sean trend meter. We're below 50 with the money flow. We're declining, but still above 50 with the ultimate oscillator. Still above the moving average with on balance volume. And then we're holding up okay here with the intermediate term RSI. That's based on 14 periods. We crossed back above 50 where we dropped slightly below it with the short-term RSI. But if you look at how we've been going up based on price and we've been setting lower highs here with the RSI, that's another negative divergence we need to be aware of. And we've gone from negative back to neutral with the Elder's Impulse system. We're still negative with the parabolic SAR. And we're coming back up to the green fluorescent short-term 10-period simple moving average with the bow tie method. And rolling over just a little bit, but the blue line's still going up, but the red line's starting to flatten out. And the red line moves faster when we look at the condition of the intermediate term trend based on 50 periods, back above the 20-period moving average here. And we're still declining though with the bullish percent index. We're below the moving average and going down. And we're going down with the NYSE bullish percent index, even though it's still above 50. And we're continuing to decline with the NASDAQ 100 bullish percent index below 50 and declining. So there's some weakness coming in here. Still on a praying bottom fisher buy signal though. I wouldn't use this by itself. You need confirmation of other things that we're just not seeing right now. And still coming up to the top end of the mini rainbow when we look at the 20-period simple moving average of the open, high, low, close. And we're still below this R1 pivot point. It's at 64.68. We're about 20 points away from that right now. And we need to get up here and close above this at Friday's close for this to actually count as breaking above resistance. For 3 weeks now, we've been dealing with this overhead resistance level and also dealing with overhead resistance here with the trend channel for the S&P. So a little bit of a doji, kind of indecisive here with the Heiken Ashi chart after it had been negative, turning back a little more positive. Still positive with the Kegi chart, black and pointing up. Still positive with the Renko chart, but looking more negative with the three-line break. So not really confirmation there. Coming down just a little bit with our 150 and 200 period moving averages, but they're still looking pretty solid longer term. We're back to positive on all time frames with all the different indexes, and where bonds are now positive in the short and intermediate term, they continue to be negative in the long term. Commodities are positive across the board, and the dollar is now back into an uptrend here. And we had communication, tech, and discretionary. These are the three big growth areas. This is why the S&P went up. Now, there were no gangbuster percentage changes here, but it was enough for these to go up, and the other areas, whether they're cyclical or defensive, they went down. We saw energy just getting hammered here. It was down pretty much there. And then we had a lot of mixture, a little more negative as we ended out the day with the Nasdaq getting above 21.4, then it went down below 21.3, then 21.5. Okay, and then Canada, another day, another new all-time high. Discretionary had a BPI cross below 80. Now 80 is showing strength. It ended up looking a little better. This was right after the open. And we had the dollar with a bullish MACD crossover. Haven't seen one of those in a while. The Dow has a bearish MACD crossover, just set a recent all-time high, and now it's not looking really good technically. And then the Dow broke below 45,000 with real estate having a bearish MACD crossover. And then oil going, now that's probably positive. When oil prices go down, it dropped below 65. And the summation index went below its 20-period moving average for the NYSE. And that's one of the charts that I showed a little while ago. So the big dark green here, that's mainly why the index went up. You take Google and then Apple was dark green as well. These are the two stocks that really helped the S&P to go up. And so Google can keep Chrome and Apple can keep using Chrome. And the market liked that. So the Dow here just kind of chopping along, still on a longer term uptrend though. neutral with the Elder's Impulse system and looking at the diamonds, and still up about more than 1%. We're back above this pivot point now with the NASDAQ, and we've gone from negative over to positive with the NASDAQ with the Elder's Impulse system, coming back above this pivot point. That's leaning a little bit more positive with the NASDAQ 100, negative back to neutral with the Qs looking at the Elder's Impulse system. And still going back to late May, early June, the momentum for the NASDAQ 100 continues to be negative. And we're above the 50 period moving average, but still below the 20 period moving average with the QQQs. And it's still dealing with this longer term trend line. It's holding up. We're not really dropping down below it, but we're wondering other times recently anyway, when we got above this, that's about where we started to really slow down. But the trend line is going up. And so even if we kind of skated along this, the NASDAQ 100 will continue to go up as well. And not really seeing much follow through strength with the small caps with the S&P 600. Also, we were virtually unchanged here with the Russell 2000 small caps. Neutral with the small caps with the Elder's Impulse system. Mid caps, little change there. Still neutral with the mid caps with the Elder's Impulse system. Wilshire up almost 0.5%, 0.43% here. Still looking pretty solid that way, as we're looking fairly solid here with the total US stock ETF. Financial sector virtually unchanged, down slightly, looking good all by itself. Saw a little bit of a pullback here with the ratio between the financial sector and the S&P, but overall it has been improving. But in the bigger context, we've been watching this ratio going down, and we want this ratio to go up to be more positive. And the FANG index, this is where most of the strength came from. Not at a new high here with the FANG index with the big stocks, but it's holding above its 50-day moving average. So Apple, it was up pretty solid there. And Amazon up just a little bit above its 50-day moving average, dealing with the 50-day moving average with Microsoft virtually unchanged. Google, yeah, up kind of nice there for a daily move. And then Meta still dealing with its 50-day moving average. Nvidia also dealing with its 50-day moving average. Tesla bouncing around all over the place. Now it's a little bit above the moving averages. And Netflix was up almost 1%, trying to get back up to its 50-day moving average. And still has been seeing a more shorter term weakness in the correlation between US and world stocks. A little bit of a tick up here, starting to roll over a bit now with the longer term correlation. And we dropped with oil. That's really what sent the energy sector down. And the dollar, it kind of dances around either its 20 or 50-day moving average. This purple line here is a 50 period moving average. I don't plot a 20 period moving average on this chart. And we did drop off here, but we're just getting to the lower end of the range with the 10-year yield. We're not really dropping down to anything new. We get down to the lower end, then we go back up, then we drop back down, then we go back up. Is this going to be some kind of a short-term bottom? Because we also hit this at the beginning of July before interest rates really started to go back up. And we did go up with the 10-year based on price, and not really seeing a lot of strength here with our growth to value ratios. The Qs to S&P still below a declining moving average, a little bit above the moving average with discretionary to the S&P. This one's holding up a little bit better. We did see a bit of an advance here with large cap growth to value, but it's still below a declining moving average. So the other large cap index that we look at, we're a little bit above the moving average. We're below the moving average with the mid caps, and the small caps continue to show more weakness. So what's the outlook then? We're back to positive across all three time frames, but we still have overhead resistance. That 64, 68 level. We'll see if Thursday and Friday even deals with that level. We're going to get initial and continuing jobless claims, the ADP employment change, and then the trade balance will be coming out as well. Another kind of influential report is unit labor costs and productivity. And then a big report will come out 30 minutes after the open is the ISM services. On Tuesday, we had the ISM manufacturing. That was actually pretty good looking, but the market still wanted to go down. Now, the US tends to lean more towards a service economy now, as we've shifted from agricultural to industrial, now over to more service oriented. So this is pretty influential. And then anything geopolitical or with the trade deals or tariffs, things like that, that may impact the market. So here is Thursday, and then we have the big employment report coming out on Friday. Here is a look at the numbers for both Thursday and Friday's session. Then seasonally, no real, it's a little bit positive here for September 4th, going back to 2002, neutral to positive with the Dow, S&P, and NASDAQ, where September tends to not do all that well. Historically, it's negative with the returns and it's up less than it's down. And then this I showed yesterday as well. September is the worst month of the year. Going back to 1950, if you want to stop this and plow through these numbers, I would just take away the headline since it seems to be backed up by what they're showing here. And then the first half of September, that doesn't perform all that well, but it's not negative. It's the second half of September that tends to underperform. We also, seasonal weakness that really didn't happen in August. We're wondering if it's going to happen in September. And then we're also seeing negative performance here for September going back to 1950. So we're looking more negative now with the McClellan oscillators and summation indexes. The parabolic SAR is negative. The momentum indicators are negative. The swing and trading oscillator is negative. And the bullish percent index, especially we're dropping under 50 with the NASDAQ 100. And we're declining, but still above 50 with the S&P, and we're still above 50 with the NYSE bullish percent index. The ease of movement, slightly negative there. The money flow is negative, and the momentum for the NASDAQ 100 is negative. I put the three smart money indicators back on the positive side because really they're not looking all that bad with all three of them. And longer term, our growth to value ratios are still holding up. It's the shorter term, pretty much going back to the beginning of August. We've been seeing a real pullback in this ratio where the discretionary to staples ratio has been holding up better. And then the bullish percent index, didn't I have that on the previous one? It's still above 50. So I guess it could go on here too. The ultimate oscillator is still above 50, even though it's declining. The vortex, they're kissing each other. And then the financial sector by itself, but still, we want to see it perform better when compared to the S&P. And we have a praying bottom Fisher buy signal, as well as the long-term special K chart. Both the daily chart and the weekly chart are still positive there. And here are the pivot points for Thursday's session. So our conclusion, we're positive on all three time frames again, but we're still below that overhead resistance. There's really no conviction in the short term as we did get back above the 20-period moving averages. Intermediate term, this is where we're seeing some weakness. But again, Thursday and Friday could end up being positive days. We could take care of that weakness, or that weakness could be a precursor to seeing more declines. And we're still positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.